Silver is crashing on your screen. You're watching the numbers fall in real time. 74, 73, 72. Every refresh makes it worse. Every candle looks heavier than the last one. And everyone is asking the same question. Is this the real collapse? Is silver finished? Is this the moment where the bubble finally bursts? That is what the screen is telling you, that silver is dying, that the story is over. But here is the problem. The screen is lying to you. Because while silver is crashing on your screen, in the real world, silver is not crashing at all. It is disappearing. And that contradiction tells you everything you need to know about what is really happening right now. Let me make this very clear before we go any further. This is not a normal market move. This is not profit-taking. This is not healthy consolidation. This is not a correction. What you're watching is a forced event, a liquidation event, a paper event. And if you only look at the price chart, you are missing the real story. Because the real story is not in New York. It is not on CNBC. It is not on your trading app. The real story is in the physical market. And that market is telling a completely different truth. Here is the contradiction that should immediately make you stop and think. Paper silver on COMEX is trading around $72. Physical silver in Asia is trading close to $100. Same metal, same day, same planet. Two completely different prices. That is not normal. That is not efficient. That should not exist in a functioning market. If silver was really worth $72, nobody on earth would be paying $100 for it. Especially not large industrial buyers. Especially not manufacturers. Especially not institutions. And yet they are. Quietly, aggressively, without panic, without headlines. While retail traders are being shaken out on screen, physical buyers are backing up the trucks. Now think about this for a moment. If this was a real crash driven by supply and demand, both prices would be falling together. Paper and physical would move in the same direction, but they are not. Paper is collapsing. Physical is holding. That alone should tell you that something is wrong. That tells you that the price you are seeing is not the real price. It is a paper price, a leveraged price, a price created inside a system that is under stress. And here is why that system is under stress. For years, silver has been traded like a financial asset instead of a physical commodity. Futures contracts, ETFs, options, swaps. Paper promises stacked on top of each other. For every 1 ounce of real silver sitting in a vault, hundreds of paper claims exist. This works as long as most people settle in cash. This works as long as nobody asks for delivery. This works as long as everyone believes the screen. But that belief is breaking, and when belief breaks, the system panics. Over the past few weeks, physical silver has been leaving the vaults at an accelerating pace. Not traded, not reclassified. Physically removed, loaded onto trucks, gone. Tens of millions of ounces in days. This is not retail coin buyers. This is not YouTube stackers. This is institutional demand. This is industry. This is serious money. And they are not buying because silver is cheap. They are buying because silver is necessary, because they need it for production, because they understand something the paper market is ignoring. At the same time this physical drain is happening, the exchanges are doing something unprecedented. Margin hikes, one after another, week after week. 8 hikes in a matter of weeks. This is not risk management. This is pressure. This is designed to force liquidation. When margins rise, traders need more cash immediately. Not tomorrow, not next week. Immediately. And if they do not have that cash sitting ready, their positions are sold at whatever price exists in that moment. When thousands of traders are forced to sell at the same time, price collapses. That collapse then triggers more margin calls, which triggers more selling, a self-feeding loop, a death spiral. Have you been staring at the charts lately, feeling that knot in your stomach, watching every support level break, seeing every little bounce get slammed back down, and just wondering what on earth is going on? It feels violent, doesn't it? Almost personal. Well, there's a reason for that. This isn't just regular selling. This isn't investors calmly deciding to take some profits. This is forced selling. And forced selling is a completely different beast. It's a hurricane. It doesn't care about your technical analysis. It doesn't care about strong fundamentals or a compelling long-term story. It doesn't care about supply shortages or record-breaking demand. Forced selling has only one goal: get out. Right now, at any price. It's a stampede for the exit, and anyone who gets in the way gets trampled. That's the chaos you're seeing play out on your screen, that sea of red that makes you question everything. But while that storm is raging in the paper markets, something fascinating is happening just beneath the surface, away from the flashing lights of the exchange. Something that tells a completely different story. Physical premiums are rising. The cost to get your hands on the actual physical metal is going up, not down. Lease rates, the cost to borrow the metal, are spiking. Why would you pay more to borrow something if it's becoming worthless? And the demand for immediate physical delivery? It remains incredibly strong. Think about that for a second. These are not the signs of a collapsing market. They are the classic signs of a market under immense physical stress. You don't pay a high premium to buy something that's abundant and easy to find. You don't pay high interest rates to borrow something that everyone is dumping. You do these things when the physical supply is tight, when you can't find the metal you need, when you absolutely must have it now, not as a paper promise for later. This is the exact point where so many people get trapped. They see the price on the screen plummeting and they panic. They assume the entire story has changed. They think, oh, I guess the demand disappeared or the shortage must be over. But here's the critical part. None of that is true. The fundamental story hasn't changed one bit. Let's look at the facts. Silver is still in a structural supply deficit. We are using more than we are mining. Industrial demand isn't just stable, it's growing, driven by unstoppable trends. The green energy revolution, with its massive solar panel installations, needs silver. The electronics in your pocket, on your desk, and in your car all need silver. The explosive growth of AI and data centers, they need silver. And who refines most of the world's silver, giving them immense control over the supply chain? It's still China. None of these powerful long-term drivers vanished overnight just because a hedge fund got a margin call. So the big question is, if the fundamentals are so strong, why does the chart look so terrifyingly ugly? The answer lies in the difference between the two markets, paper and physical. The paper market, the world of futures contracts and ETFs, can be pushed around. It operates on leverage, on margin, on rules that can be changed. You can create a massive amount of paper silver out of thin air, far more than what actually exists in physical vaults. This leverage is a double-edged sword. It can amplify gains on the way up, but it can create a brutal cascade of forced selling on the way down. But the physical market? That's a different world. You cannot leverage a physical bar of silver. You can't margin call a factory that needs silver to build its products. You can't just press a button and print more physical silver when a buyer shows up with a truck and a pile of cash demanding delivery. The physical market is bound by the laws of physics, not financial engineering. And that is precisely why this divergence exists. That's why the paper price is in a nosedive while the physical market is showing signs of extreme tightness. What we're witnessing is not the end of the silver story, far from it. This is just a chapter. Yes, it's a violent and painful chapter for anyone holding paper assets, but it's also an incredibly revealing one. It is pulling back the curtain and exposing the massive gap that has grown between paper promises and physical reality. And here's the thing about gaps like this. They don't stay open forever. The paper market can detach from reality for a while, sometimes for longer than we think is possible. But eventually, it has to reconcile with the physical world. It always does. History is filled with examples. At some point, the demand for physical delivery will overwhelm the paper games. The price on the screen will be forced to acknowledge the reality on the ground. Now, of course, this is not financial advice. I'm just a guy on the internet sharing my perspective. This is your money, your risk, and ultimately, your responsibility to do your own research. But as you navigate this volatility, I urge you not to confuse a paper liquidation event with a physical market collapse. They are two completely different phenomena. And understanding that difference right now is everything. Don't let the noise of the paper market deafen you to the signals coming from the physical world. Stay curious, stay informed, and thank you for watching. Don't forget to like and subscribe for more content like this.